$10 XRP? Most people scoff at that number. They write it off as delusion, lump it in with moonboy hype or worse. Assume it's a narrative cooked up to sell dreams. But here's the truth. That kind of thinking belongs to people who don't understand how money, velocity, and infrastructure actually work. Because when you strip away the noise and look at the numbers, the math behind a $10 XRP isn't just compelling. It's grounded, calculated, and quietly unfolding in front of us. This isn't some distant moonshot built on speculation. It's a real, trackable trajectory Ripple is engineering with precision through infrastructure, institutional partnerships, and regulatory alignment. And if you understand how liquidity functions in financial systems, especially when paired with limited supply and utility scaling across borders, you'll see why this scenario isn't just plausible, it's becoming inevitable. What we're about to dive into isn't hopium. It's not hype. It's raw data, velocity theory, asset burn mechanics, central bank onboarding, and a once-in-a-generation shift in how value moves around the world. And once you see the math, once you actually walk through the utility models, the market cap dynamics, and the institutional rails Ripple is laying down, you won't laugh at $10 XRP. You'll start wondering why you ever doubted it. If you're tired of empty speculation and want sharp, fundamentals-driven crypto analysis that's 2 steps ahead of the market, subscribe now to BeCryptoSmart. This is where the smart money comes to get clarity, conviction, and the truth before the crowd wakes up. XRP's market cap at $10, the math that works. Let's start by cutting straight to the question everyone throws around but rarely breaks down. What does a $10 XRP actually mean? With a circulating supply hovering around 55 billion XRP, a $10 price equates to a market cap of roughly $550 billion. On paper, that might trigger knee-jerk reactions. That's insane. That's too high. But that's only if you're viewing XRP through the wrong lens, if you're thinking like a retail speculator, not like someone who understands macro liquidity infrastructure. Let's zoom out for context. Bitcoin peaked at over $1.3 trillion in market cap during the 2021 bull run, and that's with no institutional settlement utility. It's mostly held as an asset, not used as a bridge for trillions in payments. Gold's market cap? Around $13 trillion. And it just sits in vaults. It doesn't move. It doesn't settle anything. Now let's look at the big one, the global payments market. This is the real playground XRP is being engineered for. According to Boston Consulting Group, the global payments market is on track to surpass $250 trillion in annual volume by 2027. That's not a typo. That's $250 trillion moving through correspondent banking, SWIFT, remittance corridors, and emerging real-time payment systems. Now ask yourself, what if Ripple and XRP capture even a sliver of that market? Here's where the math flips. Let's say RippleNet and XRP's on-demand liquidity rails penetrate just 0.5% of that $250 trillion. That's $1.25 trillion in annual settlement volume. But you don't need a $1.25 trillion market cap to settle $1.25 trillion in volume. Why? Because XRP isn't like gold. It moves. It's designed to move. And in financial models, what matters isn't just total market cap. It's velocity. Velocity of money is a foundational concept in finance. It refers to how many times a unit of currency is reused in a given time period. In XRP's case, a single token can settle multiple transactions per day, potentially dozens, depending on corridor speed and throughput. Let's do the basic velocity math. If XRP turns over 10 times a day, that is, if each XRP is used in 10 separate transactions within 24 hours, you only need a fraction of the full market cap to support a massive volume. Let's say XRP is processing $1.25 trillion in annual flows through on-chain settlement, and each token turns over 10 times per day, 365 days a year. That's 3,650 settlement cycles per token per year. Now divide that $1.25 trillion in annual flow by the total annual transaction cycles across the circulating supply. The required market cap to support that volume is dramatically lower than most people assume. That's the part retail investors always miss. They look at static models. XRP would need a $500 billion market cap to be $10. And forget that XRP isn't sitting in cold storage. It's moving value at machine speed. This is exactly what it was designed for. Liquidity bridging, not hoarding. It's not a commodity. It's a throughput engine for financial institutions, banks, central banks, and payment corridors. When XRP is used in real settlement scenarios, its value isn't just based on supply and demand, it's based on throughput capacity. And that's why the $10 price target isn't some delusional moonshot, it's grounded in basic liquidity math. In fact, if XRP adoption keeps scaling at the pace Ripple is pushing with CBDC pilots, bank integrations, and expanding corridors, $10 might end up being the floor, not the ceiling. But this is just the first layer. Because if Ripple's enterprise infrastructure starts replacing legacy systems like Swift at scale, that velocity number compounds. And suddenly, $10 looks conservative. Up next, we break down exactly how Ripple is making that vision real. From bank integrations and CBDC platforms to strategic acquisitions designed to eat TradFi from the inside. Stay locked in. Ripple's global infrastructure is laying the tracks. Let's be clear, the $10 XRP thesis isn't built on hype. It's not driven by TikTok charts, pump groups, or influencer price calls. It's grounded in infrastructure, real infrastructure, the kind that reshapes how money moves at a global level. And Ripple's strategy couldn't be clearer. Become the Amazon Web Services of global payments. In the same way AWS quietly powers the back end of the internet, from Netflix to government servers, Ripple is building the back end for the next generation of financial plumbing. But instead of cloud storage, this system moves trillions in real-time liquidity. So what does that look like in practice? It starts with RippleNet, Ripple's proprietary global payment network. RippleNet isn't some hypothetical layer. It's already operational, licensed, and used by over 300 financial institutions. Ripple has designed it to be modular, scalable, and compliant, able to plug into central banks, fintech platforms, and traditional banks with surgical precision. Then comes the key differentiator, ODL, on-demand liquidity. This is where XRP steps in as the liquidity bridge between currencies, removing the need for pre-funded accounts in Nostrovostro systems. That alone saves banks billions in idle capital and opens up a business case that legacy finance can't ignore. But Ripple's vision doesn't stop with payments. It's now moving into prime brokerage. Ripple's acquisition of Hidden Road, one of the most advanced FX and crypto prime brokerages on the market, was a surgical move. Hidden Road already works with top-tier institutions and market makers. Now Ripple owns that bridge. That means Ripple now controls both the liquidity rails and the on-ramps into institutional-grade finance. A move that mirrors how TradFi giants like Goldman and BlackRock have operated for decades. This isn't about XRP trading on Coinbase or Binance anymore. It's about XRP becoming a native component of high-frequency liquidity flows across jurisdictions, assets, and even sovereign currencies. Let's look at the partners already using or testing Ripple's infrastructure. Santander, one of the largest banks in the world. Tranglo, powering payments across Southeast Asia. SBI Holdings, Ripple's gatekeeper to Japan's institutional ecosystem. Novati, delivering real-time remittance rails in Australia. The Republic of Palau, running an official CBDC pilot using XRP Ledger as the foundation. And those are just the public names. Behind the scenes, Ripple is in ongoing discussions with dozens of central banks across Africa, the Middle East, Latin America, and Asia, each exploring the integration of Ripple's tech stack into their digital currency strategies. This is no longer about retail FOMO. It's not about price charts or meme cycles. This is full-blown infrastructure deployment at a sovereign level. Think about what that means. Ripple isn't selling a token. Ripple is embedding a protocol. And the moment you embed a protocol into banks, clearinghouses, CBDCs, fintech platforms, you create a dependency. That dependency drives demand. And that demand funnels into XRP, because XRP is the only token natively built into Ripple's liquidity model. What's happening here is long-game domination, not short-term hype. Because infrastructure doesn't scream. It doesn't trend. Quietly builds underneath the surface. And then, when everything is in place, it becomes the standard. That's the phase we're entering now. Not speculation. Integration. And the more corridors Ripple wires up, the more volume flows through XRP. setting the foundation not just for a higher price, but for a structurally sustained role in global finance. Coming up next, we break down how velocity, burn mechanics, and institutional corridor volume converge to create a supply shock most investors haven't even factored into their models. Institutional access to XRP is quietly going parabolic. Let's get to the real catalyst behind the $10 XRP thesis. It's not retail hype. It's not memes. It's Wall Street onboarding XRP at scale. Because here's the truth most people miss. Institutions don't chase altcoins. They don't care about influencers, hype cycles, or emotional trading patterns. They care about infrastructure, about regulatory clarity, about execution rails they can trust, custody providers they can ensure, and deep liquidity they can tap instantly. And Ripple has spent the last 5 years quietly checking off every box. Regulatory clarity, achieved post-SEC case. XRP is now legally recognized as not a security in the US, making it one of the few digital assets with courtroom-level regulatory clearance. Institutional-grade custody, fully integrated. Ripple has partnered and aligned with major custodians to make sure XRP is safe, compliant, and storable under institutional mandates. Prime brokerage. Delivered through Ripple's acquisition of Hidden Road, one of the few crypto-native prime brokers that already serves over 200 institutional counterparties across FX, crypto, and derivatives. Liquidity aggregation. Powered by Ripple's Liquidity Hub, which seamlessly routes institutional orders across exchanges, aggregators, and OTC desks for maximum execution efficiency. That's not retail tooling. That's capital markets-grade infrastructure. And here's where the strategy gets even more aggressive. Ripple isn't waiting for institutions to show up. It's building the pipes that institutions already use. Hidden Road gives Ripple something few crypto firms possess. Plug-and-play access to TradFi infrastructure. Think FX credit lines. Think fully compliant settlement rails. Think direct routing into market makers, hedge funds, and clearing firms without touching retail exchanges at all. This is XRP stepping out of the crypto sandbox and into the same arenas as Swift, CLS, and CME. Then there's Ripple Liquidity Hub, which is essentially a one-stop access point for institutional buyers who want XRP, USD, Euro, BTC, and more routed through the most liquid global venues, all without touching an exchange screen. This opens the floodgates for compliant buying at scale. And if that wasn't enough, leveraged XRP ETFs are already live in emerging markets like Brazil and Switzerland. These aren't just experimental wrappers, they're actively trading, with regulated exposure to XRP's price performance. So when the next wave of institutional capital comes, whether it's hedge funds, private banks, sovereign wealth funds, or even fintech rails from neobanks, they won't need to figure out XRP. They'll find XRP already integrated, already accessible, already compliant. That's the unlock, because price isn't just about speculation anymore. It becomes a function of liquidity demand, how much XRP is needed to settle real-world volume across financial corridors. And when that demand is driven by institutions, not meme traders, the price isn't driven by FOMO candles. It's driven by structural velocity and scarcity mechanics, which means that $10 XRP isn't just possible. It becomes inevitable in a system where XRP is the liquidity bridge at scale. And in the next section, we break down exactly how that velocity works, and why XRP's supply isn't what most people think it is. XRP's supply dynamics everyone ignores. Let's talk about something that's rarely discussed. Yet it's the silent driver behind XRP's long-term price mechanics. XRP is deflationary by design, not speculative, not theoretical. Every single transaction on the XRP ledger burns a small amount of XRP, forever. That's not optional. That's hard-coded into the protocol. And this isn't just some gimmick. It's the kind of economic mechanic that mimics the supply squeeze we've seen with Bitcoin halvings, only with one major difference. It accelerates as network activity grows. Now let's run through the actual numbers. XRP has a hard cap of 100 billion tokens. Period. No minting. No inflation. Over 47 billion XRP are either locked in escrow held by Ripple or tied up in long-term custody and use cases. That leaves around 55 billion XRP in circulation. But here's what most people don't realize. only a fraction of that is actually liquid. A growing chunk is already tied up in ODL corridors, institutional custody, whale cold wallets, and locked into liquidity provisioning frameworks across Ripple's global partner network. Now layer on the deflation. Every time a transaction takes place, whether it's cross-border remittance, a CBDC bridge, or an enterprise payment via RippleNet, XRP gets burned. Forever. This means the more XRP gets used, the less of it exists. We're talking structural supply compression baked into the asset itself. Think about that in context. If Ripple expands CBDC pilots across 5 or 10 more countries, if ODL volume scales across banking corridors in APAC, LATAM, and MENA, if more institutions use XRP to provision liquidity at scale, that burn rate accelerates. And while the amount burned per transaction is small, the cumulative effect becomes enormous when scaled globally. This isn't a hypothetical, it's happening now. The market is slowly realizing something that few are pricing in. XRP supply is becoming progressively illiquid. Between institutional custody, long-term hodlers, and daily protocol burns, the real available float is shrinking, which means XRP is walking into a classic supply shock scenario. Not because of hype, but because actual demand is being met with reduced liquid supply. Here's how that plays out. Utility demand ramps up through CBDCs, ODL, tokenized assets, and FX settlement. XRP gets burned with every transaction. Available liquid supply declines. The market hits an inflection point where demand exceeds real-time availability. That's when the price doesn't just rise, it reprices. Not based on sentiment, but based on structural economics. That's how you get a rising price floor before speculative money even shows up. And when that speculative phase does hit, you're no longer starting at 50 cents, you're starting from a much higher base. So when we talk about $10 XRP, we're not talking moonshots. We're talking delayed math catching up to utility and scarcity. And in the next section, we'll show you why the global liquidity crunch is going to make assets like XRP not just useful, but absolutely essential. $10 XRP, the final forecast. Let's connect all the dots. Because once you zoom out, the $10 XRP forecast doesn't look like a fantasy. It looks like math catching up to momentum. Here's the simplified, conservative model. No wild assumptions, just raw fundamentals. Start with this premise. Ripple's network facilitates $1 trillion in annual settlement volume, from banks, remittances, corporate treasuries, and CBDCs. That's not a stretch. The global cross-border payments market is projected to surpass $250 trillion by 2027. If Ripple captures even 0.4% of that, it's in the $1 trillion zone. Now let's bring in velocity theory. The average velocity of money on the XRP ledger is currently around 3.8x to 4.2x daily, meaning each XRP is used and reused multiple times across payment corridors. So that $1 trillion in settlement volume doesn't require $1 trillion in XRP market cap. Using 4x daily velocity, the system only needs about $685 million in active XRP liquidity per day to support that $1 trillion throughput. Seems manageable, right? But here's the catch, and the part 99% of analysts overlook. Only a small portion of XRP is actually available for real-time liquidity. Let's run the numbers. Total XRP supply is capped at 100 billion. Roughly 55 billion XRP are in circulation. But only 10% to 15% of that is actively liquid at any given moment. Most of it is locked in institutional custody, sitting in long-term cold wallets, tied up in ODL corridors, held by Ripple for strategic deployment. So that $685 million in daily demand starts to clash with a thin, illiquid float. And what happens when demand for settlement liquidity rises, but the available XRP pool shrinks due to burns, custody, and utility lockups? Price adjusts rapidly. That's not moon math. That's a basic market squeeze, a supply and demand imbalance triggered by actual usage, not retail hype. Now let's contextualize this. Ethereum didn't move for years. Then DeFi hit and ETH went 10x. Bitcoin was written off until ETFs and corporate treasuries created a global liquidity bid. Solana flatlined. then exploded on the back of narrative and meme-driven volume. What changed in all these cases? Infrastructure matured. Liquidity bottlenecks cleared. Real-world usage kicked in. XRP is right at that inflection point. But instead of meme coins or hype tokens, the narrative here is financial infrastructure, CBDC bridges, FX rails, bank integrations, liquidity hubs, and regulatory clarity. Ripple is building the digital plumbing of money. XRP is the liquidity layer that powers it. And when the pipes are finally in place, when central banks, institutions, and remittance networks start pushing volume through those rails, price becomes a reflection of strain, not speculation. That's how $10 XRP happens. Not because of influencer hype, not because of a halving event, not because of FOMO cycles, but because utility hits capacity, and the market reprices XRP accordingly. It's not linear, it's compressed. Flat accumulation, then sudden escape velocity. That's the pattern. And XRP is nearing that breakout moment, backed not by noise, but by decades of infrastructure quietly being laid beneath the global financial system. $10 XRP isn't a dream. It's a demand-driven inevitability when liquidity, velocity, and scarcity finally collide. Still think $10 XRP is a pipe dream? Let's recap what we just walked through. A hard supply cap paired with real utility burn. Institutional-grade infrastructure built beneath our feet. Global payment corridors already running on Ripple tech. Prime brokerage access, liquidity hubs, and ETF pipelines in motion. The math works. The rails are live. The demand is brewing. The only thing missing? Recognition. And that's how markets behave. They price it in after it happens, not before. By the time the headlines scream, XRP just hit $10, the biggest moves will have already been made. The smart money will already be positioned. The latecomers will just be exit liquidity. So don't sleep on what Ripple's building. Don't ignore the convergence of utility, scarcity, and institutional integration. Subscribe to BeCryptoSmart right now for the sharpest breakdowns on XRP, behind-the-scenes financial moves, and the insights most retail investors miss until it's too late. Because by the time XRP hits $10, it won't be hype, it won't be luck, it'll be inevitability, and you'll either be watching from the sidelines or cashing in on conviction.